my name is Dana Golden. Today we're continuing our look at capacity markets, and today we're talking about market equilibrium and how these markets balance out. So the first step in creating market equilibrium is for the ISO to determine capacity market demand through forecasting. So what you do is you try to ensure sufficient capacity is procured to meet peak demand, plus obviously the reserve margin, which means that you want a little bit more capacity than you need in case there's more than predicted demand, so that you can have a little bit of a buffer for reliability. So the first step is that you forecast load, you project peak demands for delivery period. Using historical data, weather patterns, and economic factors, you want to incorporate any factors like increase in population and expected growth in electricity consumption. Particularly, you want to think about electrification. You want to think about the fact that there are a lot of Teslas coming online. There's a lot of people who are electrifying a lot of things. Next, you want to calculate reserve margin, which is a safety buffer to ensure reliability during unexpected demand spikes and generator outages. Typical reserve margins have a pretty big range, but they start at 10%. You want to next analyze reserve adequacy, assess the available supply to meet forecasted demand, accounting for outages and retirements. Then you want to look at data inputs. You want to look at historical demand patterns and weather data. You want to look at economic indicators affecting electricity consumption. How large is the growth base? Are people leaving? Are people coming? Is there going to be more demand soon? Is there going to be events that will affect the amount of demand? Are you forecasting an exceptionally cold or hot year? And then you want to look at, are there known generator additions, retirements, or maintenance schedules that are coming online that will affect how much capacity you need and how much you want to incentivize capacity availability. And not everything's going to be certain and known. You're going to have a lot of variability because of weather and extreme events that you want to calculate. And that goes into how much reserve margin you'll need. How worried are you about those? Then there are possible energy policy changes that will lead to entry and exit. Inflation Reduction Act was an unexpected energy policy change that you can debate as to how priced in that was. And of course, there's also the integration of renewable and distributed energy resources that you're not sure how much they'll generate, but also how quickly they'll come online. And then you want to think about the slope and shape of the capacity demand curve, and this will affect how well the auction will work to determine the price given the relationship between supply and demand. So the purpose of the demand curve is to reflect the relationship between capacity, procurement, and price. You want to make sure that you're not overpaying for capacity or under purchasing capacity based on the true cost reliability. Ensure that this is sufficient capacity to be procured without significant price volatility. You don't want to pay exceedingly high prices, but you want to make sure you're buying enough capacity. Then you want a typically downward sloping demand curve indicating that a higher willingness to pay for capacity is very valuable at levels near critical. There's a vertical portion of capacity where you really need this amount of capacity and you're willing to pay almost anything to get it. And then there's a downward sloping demand where you reduce in your willingness to pay for more and more capacity. Eventually, your capacity payments get to zero as you have enough capacity in the market. So the slope of the demand curve, steeper slopes near required capacity levels ensure reliability is met. And then you have sour slopes as you have more and more capacity until you have a horizontal capacity curve at zero. So the fact it's influencing the shape and slope, obviously reserve margins, how much do you want to downplay the risk of scarcity? How much do you have scarcity pricing? More aggressive scarcity pricing steepens the curve at near critical levels. So if you are pretty confident that your scarcity pricing is high enough that people are willing to take a risk on that scarcity pricing for the variable costs coverage, then you might decide that less of the cost of new entry needs to be covered by the capacity market. And obviously, the curve should be shaped to meet policy objectives. It should be adjusted to reflect renewable energy integration and specific reliability goals held by the ISO. PJM and ISO New England both had demand curves that interact with locational factors to take into account their regional constraints. NISO also does this, and both have downward sloping demand curves that adjust for resource adequacy and economic efficiency. There's a good demand curve. In some ISOs, this is a vertical portion because you need this portion. You're willing to pay a lot for it. And then you have a downward slope, and you have an increasing downward slope as you have more volume, and eventually you don't pay more for capacity procurement, and the price of capacity is zero. And there's a concern that in some of these ranges where you have these changes, you might have market power where some firms will deliberately not provide capacity because they want the payments. And then here are net cone for NISO, ISO New England, PJM, and they help determine how you're willing to pay for capacity. At the start, you're paying for the entire net cone because you want to encourage any resources you can to join. And then once you've hit the capacity requirement, you pretty steeply fall until you get to zero. So one thing I'll say is that there's been consistent overestimation of net cone by the Northeast RTOs, including ISO New England and NISO, a little bit of PJM as well. This represents the cost of building, net cone represents the cost of building a new resource, net of the expected revenues from the energy and ancillary markets. So we talked earlier about cone, which is the cost of new entry, which is how much it costs to build a new resource. Net cone is once you subtracted the revenues they expect to get in the actual market, how much is that cost, and that is the real missing money problem. It's critical input in setting capacity market demand curves and offer caps. In Northeast RTOs, net cones consistently exceed real-time costs and market conditions. Usually, they're using technologies that are not standard. This is run by FERC, and FERC has to approve this, but there still tends to be higher capacity market clearing prices and over-procurement capacity historically. It's gotten a lot better, though, and this leads to increased costs that are passed on to consumers. And the impacts of overestimation is you have an inefficient market signal, and you have older players like coal plants that will take longer to leave the market, and you'll have inflating cone, which might lead to overinvestment in capacity. You'll have higher consumer costs as consumers now have these capacity requirements passed on to them, and you'll have barriers to entry for new resources because there's an discouraged investment in innovative and new low-cost technologies, and you won't have access to that scarcity pricing because you'll always have coal in these other places there. ISO New England and NISO have faced a lot of criticism over overly conservative net cone estimates that have led to overcapacity. Potential flaws that might lean to this overcapacity, some methodological issues that you might be aware of if you're ever trying to do this, you're ever thinking about working in this market. There's often overly conservative assumptions that reflect outdated or overly pessimistic assumptions, particularly related to technology. For a long time, they were using older technology. They hadn't integrated combined cycle natural gas as the marginal technology, which should be utilized in cone calculations. And they really ignore recent declines in technology cost, especially with respect to natural gas, but of course with respect to renewables and storage, which has really changed how we should be calculating cone. Next, it's a static energy revenue estimate, so it doesn't take into account, it tends to underestimate the market revenues from energy and ancillary services, and it doesn't account for the fact that this very much will change as you have a change in capacity. So it fails to account for dynamic market conditions and price volatility. As you have changes in capacity, this will increase and decrease to offset net cone, to decrease net cone in ways that will lead to overestimated capacity. There's often misaligned risk premiums, which assume high financing costs or risk premiums that may not reflect actual investor expectations. And it tends to be limited consideration for resource diversity, with a focus on traditional generation like peaker plants, to the exclusion of more flexible resources like demand response or cheaper resources like renewables. Yeah, this has been criticized for the one-size-fits-all approach. It may not reflect fully locational differences. NISO is moving towards even smaller zones to incorporate the increasingly granular need for different capacity markets and capacity prices. There's insufficient stakeholder engagement. There's not input from diverse market participants, and it tends to be biased towards utilities who are willing to overpay often for capacity. And obviously, there's a worry that there's an inflated capacity prices driven by that drive higher capacity costs, burdening consumers and creating market inefficiencies that distort market outcomes. So some recommendations that have often been brought up for improvement is to use updated technologically specific investment cost data. This is moving forward pretty quickly, incorporate forward-looking energy revenue projections, and engage stakeholders to refine assumptions and methodologies. And then I'm going to leave it here, and next time we'll continue with a look at defining the capacity price.